Amazon made $78 billion in profit last year. But its free cash flow? Barely $1 billion. Where did all that money go? One answer: the biggest infrastructure bet in corporate history. $200 billion in a single year. Genius or a trap? By the end of this video, you will know exactly what Amazon is building. Hit subscribe and let's dive in. Rewind to July 1994. A 30-year-old quits his Wall Street job, drives across the country, and starts selling books from a garage near Seattle. First month, orders from all 50 states. The site nearly crashed daily. That tiny bookstore was Amazon. The lesson from day one? Obsess over customers, ignore the skeptics, and grow faster than anyone thinks is reasonable. Amazon went public in May 1997 at $18 a share. About 8 cents adjusted for splits. Then the dot-com bubble burst, and the stock collapsed more than 90%. Analysts wrote obituaries. Amazon refused to die. It cut costs, posted its first profitable quarter in 2001, and kept building. Everyone who panicked missed one of the greatest comebacks in market history. Then came two inventions that changed everything. 2005, Amazon Prime. Pay up front, shipping feels free, and suddenly you buy everything there. 2006, Amazon Web Services, renting out its own computing power to the world. One locked in customers. The other quietly became the most profitable cloud business on earth. Two decisions, 20 years ago, still power the entire machine today. Here is the business model in one word: Flywheel. Lower prices bring more shoppers. More shoppers attract more third-party sellers, who now drive over 60% of everything sold. More sellers mean more selection, which brings even more shoppers. Amazon collects fees on every layer: selling, shipping, storage, advertising. The wheel spins faster every year, and it is brutally hard to stop. Now the real moneymaker. AWS rents computing power, storage, and now artificial intelligence to millions of companies. It is only about 20% of Amazon's revenue, but it generates roughly 60% of operating profit, with margins near 40%. Netflix runs on it. Governments run on it. And in the AI era, demand is exploding faster than Amazon can build. And then there is the business nobody talks about: advertising. Every search on Amazon is a buying signal, and sellers pay billions to appear first. Ad revenue grew 24% to over $17 billion in a single quarter. That is an annual pace above $70 billion, bigger than Coca-Cola's entire yearly revenue. Nearly pure profit, hiding inside a retail company. Let's zoom out to the full picture. 2025 revenue, $717 billion, up 12%. Net income, $77.7 billion, up 31% from the year before. More than 1.5 million employees. Deliveries across the globe. If Amazon were a country, its revenue would rival a top 25 economy on Earth. Now the latest quarter, and it was a monster. First quarter 2026 revenue, $181.5 billion, up 17%. Operating income, $23.9 billion. That is a 13% margin, the highest in Amazon's 30-year history. The low-margin retailer story is officially dead. Ads, cloud, and automation are turning this into a high-margin machine. Inside that quarter, the star was AWS. 28% growth, the fastest in 15 quarters. $37.6 billion in revenue, $14 billion in operating income. AI services alone crossed a $15 billion annual run rate. And the backlog, contracts already signed but not yet delivered, hit $364 billion. That is future revenue, locked in today. Add it all up, and Amazon is worth about $2.64 trillion, the fifth most valuable company on Earth. But here is the twist. The stock sits around $246, roughly 12% below its high, and it has lagged its big tech rivals this year. Record profits, falling stock. That disconnect is exactly where this story gets interesting. So why is Wall Street nervous? This number, $200 billion. That is Amazon's planned capital spending for 2026 alone, about $50 billion more than analysts expected. First quarter spending already hit $44 billion, up 77%. Data centers, power, chips, robots, satellites. The largest single-year infrastructure investment by any private company, ever. And it is crushing free cash flow. Here is the part most people miss. Amazon designs its own chips. Graviton for general computing, Trainium for training artificial intelligence. That chip business just crossed a $20 billion run rate. Trainium 2 is sold out. Trainium 3 is nearly fully booked. Every chip Amazon builds itself is a chip it does not buy from NVIDIA at triple the price. That is the hidden margin play. And in April 2026 came the blockbuster. Amazon will invest up to $25 billion in Anthropic, the maker of the Claude AI models. Anthropic committed over $100 billion of spending on Amazon's cloud over the next decade. Together, they are deploying up to 5 gigawatts of new AI compute. That is the power draw of a small country, dedicated to one partnership. Short term, 3 things to watch. 1. Prime Day just smashed records, with roughly $26 billion of U.S. online spending during the July event. 2. Second quarter earnings, expected around late July, with guidance of up to $199 billion in revenue. 3. Any sign that AI spending is turning into AI profit. Each one can move this stock fast. Long term, watch the quiet revolution inside the warehouses. More than 1 million robots already work alongside staff, with new AI systems coordinating them like a swarm. Rufus answers shopping questions. Alexa Plus is rolling out to millions of homes. Every point of retail margin that automation adds is worth billions in profit. Some analysts think retail margins could double by 2030. Then there is Project Kuiper, Amazon's satellite internet constellation, growing with every launch. The goal, broadband for hundreds of millions of people the cable companies never reached, and a direct rival to Starlink. Add healthcare, groceries, and self-driving taxis through Zoox, and you see the pattern. Amazon never stops planting seeds. Most stay small. But the ones that grow become AWS. Now the risks, and they are real. Risk 1, the money. $200 billion in spending has crushed free cash flow to barely $1 billion over the past year, and Amazon is now leaning on debt markets to help fund the build-out. If AI demand slows, or those data centers sit underused, this becomes the most expensive miscalculation in tech history. Overbuilding has humbled giants before. Risk 2, the government. The FTC is preparing a case claiming Amazon misled advertisers, with potential penalties in the billions. A separate class action says it overcharged customers during last year's tariff chaos. And competition never sleeps. Microsoft and Google in the cloud, Walmart online, Temu on price. None of these kill Amazon. But each one can take a bite out of the margins. So what is the price tag? Around 33 times last year's earnings. Expensive versus the average stock, but this is not an average stock. Profits grew 31% last year, and most analyst targets sit well above today's price. The bull case, margins keep expanding and the capex pays off. The bear case, you are paying a premium while cash flow is near zero. Both can be true. If you want in, Amazon trades on the Nasdaq under the ticker AMZN, and most brokers offer fractional shares, so even $10 buys a slice. Prefer the basket approach? Amazon is a top holding in S&P 500 and Nasdaq index funds. The boring playbook still wins. Buy gradually, spread your entries over time, and size it so one bad year cannot shake you out. Jeff Bezos called it day one, the idea that Amazon must act like a startup forever. 32 years in, it is betting $200 billion that the AI era is just beginning. Watch the next earnings. Watch the cash flow. This video is for education, not financial advice, so always do your own research. If it helped, subscribe for a new deep dive every day. See you tomorrow.